You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Look who's back. Yep, I'm back. I'm ready. We're going to start talking strategies. Had a very long and lovely but cold holiday over the holiday period. And I am now back in my home office in Lake Wylie, South Carolina, not far away from Charlotte. And we were up in Wisconsin. The weather was not the most fun that we've ever had, but we definitely had a white Christmas, if you want to emphasize the positive overall, which is always a beautiful thing or in general. So with that said, let's just jump into a strategy this year. So we're going to be short and sweet on Options Playbook Radio here, in that we're going to look at a stock and a strategy that I don't know if the strategy we've talked about, because I think we've gone through every strategy inside the Options Playbook, and that's the entire goal of the show, is to try to come up with scenarios on specific stocks that will fit a specific strategy. It always makes it tough, because one of the things about picking stocks is if you're doing it in the options world, you want to pick option contracts that are fairly liquid. And sometimes you might find the perfect stock, but the width between the bid-ask spread on the options contracts make it basically impossible to talk about that stock. So today we got Micron Technology. We do have some decent volume in Micron. The options market is it's not like Apple, but it's not bad overall. But Micron Technology, which I talked about on the stock play of the day over on the Ally YouTube channel, and I showed some of the graphs and that will back up this statement overall. But Micron Technology is approaching the high that it reached back in 2000. So Micron has not seen 95 since that date, and most recently we bumped up against that all-time high a couple of times now. So with that said, obviously with Micron, especially a big number like that hasn't been reached in so long, it would be a very good, charting-wise, it would be a good sign for the stock if you could break out to new highs. I think the actual high was a nice round $97.50 is the all-time high in Micron Technology. Right now, with the markets closed, we're taping Options Playbook Radio. It is Wednesday the 12th. Micron closed at 95.11. It's up 91 cents on the day. And we're going to look at a long straddle. Micron in general has been a volatile stock, but the implied volatilities aren't that high. And whenever I've talked about long straddles, I've never ever actually suggested that we do a long straddle because of a known event. Those are almost impossible to pull off overall, because if it is a known event, the implied volatilities will be ramped up because of that event, and you're trading implied volatility and the swing in implied volatility as much as you are trading the actual movement of the underlying stock. And a lot of people think that, if I'm going to do a long straddle, it means I'm buying the at-the-money call, buying the at-the-money put, that the best time to do that is the most obvious one around earnings. And you can win, you can lose. You're going to know in a hurry. That's one thing about earnings, is that they're going to announce that, and that stock is going to move after that earnings date. But I prefer to look at a chart and find where a stock is at a precipice, where you have some wild swings, you have some volatility, but some predictability. And if you look at the chart in Micron, or actually go to the Ally YouTube channel, just got to Google that and find that channel, inside the Stock Play of the Day playlist, we also talked about it. Now, you might say, well, Brian, if you talked about it on Tuesday's Stock Play today, why are you talking about it now? Well, on Tuesday's show, we actually looked at a more basic strategy. We just talked about a long call spread. And the more that I looked at it and the more that I thought about this, I think it might be feasible to do a long straddle, and I don't have many opportunities to talk about it. The most recent long straddle that we looked at, that I know was that the trade worked out, and it's very obvious after I say it, was Boeing. And in Boeing, it wasn't, we weren't looking at it because of the pandemic or anything that was happening in regards to that and the airlines and everything, but it was more about when they had their trials and tribulations with their planes staying in the air and all the unfortunateness of those accidents that happened. And when were they going to be back? When were the planes going to fly again? So we did a few long straddles and talked about that from time to time, because the news events were very random. Once a week you seem to get some type of news on whether the planes were going to be released to fly again, or whether it was going to be another month, or the process that was involved with it, that added volatility above and beyond where the implied volatility was in the options contracts. Okay, so I kind of see that situation here right now, Micron Technology. And in this instance, we have a $95 stock, so it's not an outrageously priced stock. It's not a Google or an Amazon or NVIDIA, those type of stocks. But we also have it trading at about 36% implied volatility. So to me, that's not a bad scenario. And as always, on Options Playbook Radio, I have to emphasize this. We're just looking at scenarios that fit trades. It's not necessarily a forecast on the underlying, and they're always intended to be paper trades. We're trying to learn here on Options Playbook Radio overall. So if you're going to be out in the real world and you're going to be talking about options, the long straddle is one that a lot of people that want to get you excited about options, maybe to sell you a course or something, like to talk about, because they say to yourself, well, if you don't know where the stock is going to go, but you do know it's going to move, here is a great strategy that will benefit if the stock goes down or if the stock goes up. Unfortunately, if you look at the profit and loss graph, it's a very interesting profit and loss graph, but they also fail to mention implied volatility when they're talking about that strategy overall, and that the marketplace has already kind of figured in the potential move in general. So most of the time, and they say if you're going to do a long straddle, you really need the stock to make at least a one standard deviation move, either to the downside or to the upside. How often do stocks make a one standard deviation move? About 32% of the time, if you believe the math. And that's not necessarily exact, because we're just talking about the generic math of a normal distribution as opposed to a log normal. But with that said, about 32% of the time, if you go to the expiration date, it's not going to make that one standard deviation move. So if you pay that for a long straddle, that means 7 out of 10 you're probably not going to make money on, especially if you ride them all the way to the expiration date. So you have to have the situation right. You have to understand the math that's behind a long straddle. And let's look at the one in Micron. Okay. So I'm going to go through a few things here. If I am doing this long straddle, I do not want to be around during earnings. So one thing that I start out by doing is trying to find and go to the Ally Invest website inside the option chains. It gives an estimate as to when earnings might be. Right now, they don't have an official date. They're just implying that it might be the beginning of April. So I always want to make sure that that is correct by what I see in the option chains. So I go out to the option chains, look at all the expirations leading into the April 15th, or I should say, I don't know, it's April 14th expiration, which is the third Friday in April. They're saying the earnings should be the beginning of April. So let's see what that is trading at implied volatility wise. And sure enough, yes, it's trading about 4 vol points higher than the expiration that ends in March, on March 18th. So yeah, there looks like there's something up. So that number looks fairly decent. So I'm okay with anything all the way up until that known earnings date. We're going to go out 44 days in time. $95 stock. I always prefer the long straddle over the long strangle. Much the same reason as if I were to flip this trade and I were to sell this straddle or strangle, I'd rather sell the strangle as opposed to the straddle. If I do the straddle, it's got, in order to lose the maximum on the trade, it has to stop right at that strike price, right at 95. Stock's at 95.11. We're going to buy the 95 strike. We're going to go out 44 days in time. Our expiration date is going to be February 25th, 2022. If I buy the put, buy the call, all in one trade, I am showing the midpoint on that trade at $9.53. That would be $953 plus commission to buy a 1-by-1 straddle. It's not outrageous, especially when we're talking about paper trades. We just look at one trade overall. But I'm going to emphasize the fact that the only way we can lose that entire $9.53 is if we wrote it all the way to expiration and 44 days from now the stock was trading right at 95. That would be the only way that we lose the maximum on that trade. So also another way to look at it is to say to yourself, okay, if I put this trade on for $9.53, I'm not going to ride it all the way to expiration, just in general, right? I don't plan to. I'm going out further in time to give myself a little bit of a buffer on this trade, and time gets cheaper as we go further and further out. So I say to myself, well, what's my true risk here? What if I held this trade for 30 days, which in my mind would be a real long time? In 30 days from now, you would be looking at the January 28th call options. They have 16 days remaining to expiration. So I'm going to look at the at-the-money straddle for that expiration. Okay, so now this is, you got to hang on with me here for a little bit, but if you think about it, if nothing else changes in the marketplace, okay, so there's a lot of assumptions, just like profit and loss calculators make assumptions overall. So volatility stays where it's at. And we have, this normal marketplace at all. We don't have the VIX skyrocketing to 50, 60, or 70. And we just overall look at what the long straddle would be with 16 days remaining to expiration. That would be similar to what the January 28th expiration is trading at for right now. And if I buy the 95 straddle with that January 28th expiration, that's trading for $5.70. So if I think of this, I'm really risking approximately $4, because the worst case scenario would be if we held it for 30 days on January 28th and it was right at 95. Well, that means the stock didn't move at all. We needed it to move, and it's not. It's not picking up deltas on the call side, on the put side. And I could possibly sell it for somewhere around $5, $5.50, maybe even $6. Who knows? So that's my true risk of this trade. So those are a couple scenarios why I don't mind putting this trade on, because of what we see in the charts and what's going on in Micron Technology. And also there's a flight to quality. And I talked a little bit more about Micron and the PE. It trades at a very low PE relative to its peers in the marketplace in general. And there's kind of a turn from risk in the marketplace. And a lot of the stocks that have done well are the ones that are starting to pay a dividend. And Micron actually just announced that it's going to be paying a dividend, a very small one overall, but they're going to go back to paying a dividend again, which they haven't done, I think, since before the year 2000. And the moral to the story is the conditions seem to be right to consider a long straddle. Okay, so let's go back through the actual trade. We're looking to buy Micron Technology, February 25th expiration, 95 strike put, and at the same time and the same trade, buy that same expiration, 95 strike call. Right now it's trading at a net debit of $9.53 at the midpoint. That's $953 plus commissions to do a 1-by-1 straddle. The natural, if you put it at the market, is actually $9.75. It's about 20 cents more. Not too bad overall. But like I said, these are not the most liquid options. They're not bad, but they're not Apple in general. And today is Wednesday, the 12th. The markets are closed. This is going to give us a lot of time to watch this trade overall. So I'm going to put a little note on it, take a little screenshot of this, and we'll try to talk about it. Now, I totally believe in legging out of these trades. If I do so, though, I want to make sure that I'm at least covering the costs on one side of the trade. So, for example, say the market went down. Right now, the put is trading for $4.70 at the midpoint. I would want to be able to sell that put for at least $10 to get out at a small profit on the trade before I would consider getting out of the put side. So I'm going to let it ride probably for 20 days is the way that I would approach it. I talked about 30 days to that expiration, but I'll probably let it, if I were to do this on paper, I would let it ride for the 20 days. The market hasn't done what I expected to do. I would just get out, take my comeuppance and move on. If the market does move and if it's going in one direction and I think the momentum is there, I'll just stay in the trade overall. But I would consider laying out of the trade if just one side of the trade actually could pay for the total cost of the long straddle. And then I would just remain along the other side and decide when I wanted to get out of that trade. And then once I get to that position, I can just let it ride all the way to expiration if I want to. I can decide I'm in control because you are, quote unquote, playing with the house's money. You have no more of your money at risk by doing that trade. So, interesting trade to kick off this year. I wonder if we will do, I'd actually like to almost take a poll. Do you think we will do any more long straddles for 2022? Last week, we actually, I really enjoyed last week's show. We talked about the success of the program overall and highlighted some of the most popular shows of 2021. So you might want to check that out. And I hope that we can build on that success in the new year. And please share this with social media, Twitter. Let people know about Options Playbook Radio. And if you have any feedback, which I did receive some feedback, people would like me to go into a little bit more detail on adjustments, which is always tough overall because you only are doing the podcast one day a week, so it depends on where the stock is at on that day. But with that said, we'll try to work in some more adjustments here in 2022. That is one of the feedback that I took seriously, and I'll try to do that. So, if you'd like to give some more feedback, please send it to theoptionsguy@invest.ally.com. the options with an S guy at invest.ally.com. Thanks for listening. We'll be back same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.